Good evening and welcome to Masterclass by One Finance. I'm Sonam Khatri and I'm going to be your host for the evening. This masterclass are made or enables you to be stronger at your personal finances. It gives you the power, empowers you to basically understand your personal finances better and obviously take informed decisions. We at One Finance offer holistic financial advisory, and this is done through our qualified financial advisory only. Our qualified financial advisors are the core to our advisory, and that's why we always get these QFAs at One Finance to get started on the masterclass. Today's topic is achieve peace of mind through term insurance. It's an important aspect of your holistic financial planning, that is emergency planning. Yes, you need to be prepared for emergency, and term insurance is one of the topics that definitely needs to be covered in our masterclasses. And joining us today, our qualified advisor is Mr. Sumit Ramani. He's an actuary and a co-founder at ProtectMeWell. He has around 15 years of experience in the insurance space. He constructs, deconstructs financial products and simplifies for the personal finance for everyone. Thank you so much, Sumit sir, for joining us today.
Thank you,
Thank you
Sonam,
so
for
much.
having me here.
We very lucky to have you at the masterclass. The superb experience that you have for insurance as a space will definitely benefit our viewers today. Not to forget, masterclass is live on YouTube, Instagram, and LinkedIn. You can watch it at any platform that you prefer. At the end of the session, we'll be taking some questions around 10 to 15 minutes. If we miss any questions, we'll definitely tell Mr. Sumit sir to reply back whenever possible. We'll see to it at least you're replied back on the same. And not to forget, you can always put your questions in the comment section or personally even messages to Mr. Sumit Ramani sir. He's available on LinkedIn and Twitter, both the platforms.
Yeah, happy to
Absolutely.
answer. Yeah.
Term insurance is an extremely important topic, sir. It's a financial security for you, your family, whenever the policy holder goes through an unfortunate death or anything happens. What's still like in India, it's not covered. Why? Like the risk is big here. Why are we not even covering this topic?
Yeah, I think let's just start with what is risk.
Yeah.
Uh, Most people understand luck, so let's start with luck. Risk is just negative luck, right? So an acknowledgement of the fact that there are things which are beyond our control. We generally, if something goes positive, we say we got lucky, but we rarely acknowledge the fact that okay, if things go wrong, that was a risk which was already lying in there, but we did not acknowledge it. Answering your second question, why if there is a risk already there, why people do not buy a term insurance,
Yeah.
right? So, and just to put numbers to it, right? According to the latest reports, the protection gap in India for life insurance is 92%, which essentially means that on an average, if an Indian died and if he needed about 100 rupees, he was only covered for 8 rupees, which means that there was a protection gap of 92 rupees or 92% in that sense, implying that then the family will have to find that pool of money either through personal loans, and that starts a downward spiral that we all aware of. So that's the protection gap. And to understand, even though some of us are quite aware, why don't we end up buying the right size of term insurance? I'll take you back to maybe mid 14th century. This was during the time of Black Death, when it was spreading in the Europe. It also spread in England, and that's when Scots thought, now that England is slightly in the weaker position, why don't we attack them? So they got together, assembled in the jungle, and just before they were before they were planning to attack, they were infected by the virus, and then they had to retreat. Right, there was no way they could attack England. So when they retreated, went back to Scotland, they infected 1/3 of the Scottish population. So all I'm trying to say here is that we always think risk is for someone else, which is what Scott thought this time. That okay, this is a virus, but only England would get impacted because of it, and we are kind of immune to it. The reality is we are all exposed to risk. And 700 years later, today, we continue to think the same way, that risk is for someone else and I'm immune, and hence we do not end up buying term insurance or any or any protection focused insurance for that matter.
Absolutely. So yes, we have covered two topics already. What is risk and what is protection? Why there's so much of a protection gap in India? But there are a lot of things that we need to cover under this topic. So Sumit sir, stage is yours. Go ahead. All the best, and viewers, please stay tuned. Thank you.
Thank you, Sonam. So we're talking about achieving peace of mind through term insurance, right? So let's also spend some time on what gives peace of mind or what steals away peace of mind. So taking simple examples, right? So if I've invested in a stock, what will give me peace of mind is a certainty that it will grow at a certain rate. If I've uh, if I'm working in a corporate setting, what would give me a peace of mind is basically, uh, can I get a consistent job hike, appraisal or salary hike year on year? If I'm heading towards office, what would give me peace of mind is my taxi driver turning up at the right time and giving me a guarantee that I'll be on time. So essentially, anywhere there is a uncertainty, it steals our peace, and all we aspire for then or is really is the certainty. And this is where term insurance comes in handy. It gives you a certainty of the financial cash flows that your family would have a similar lifestyle for rest of their life, even if you are not around, which essentially is the core purpose of term insurance, right? So it essentially is a product wherein you pay premium up until you are around, and in case of unfortunate event, the family gets a lump sum amount which could take care of their lifestyle for rest of their lives, right? So essentially, the purpose of term insurance then becomes ensuring similar lifestyle for dependents in case of an untimely demise. It is really the purest form of that insurance, wherein it's pretty straightforward, right? You pay premium, you get a benefit in case of an event. So as simple as it could get. So then the next thing that we wish to discuss is why should you buy term insurance, right? Uh, the first thing is, since it is a product where it only covers the risk, it is the cheapest form of insurance when it comes to life insurance, which also means that for a small premium, you get a very high cover. Second, it's a good idea to buy it early, while it's important to then understand who insurance company is willing to cover, right? They are willing to cover who are good risk, who are less likely to die during the term of the policy. So they would want to insure someone who is young, healthy, and less likely to die during the term, and hence it's a good idea to buy early, get in guaranteed premium for rest of your life, which is lesser than getting in, let's say, in late 30s or early 40s. It obviously gives financial security to a family in case of an unfortunate event. It's simple and easy. Insurance products tend to be very, very complicated, and a part of it is also because people like me. But in case of term insurance, it's pretty straightforward, and hence it's quite comparable as well. Right? So if you recall, when early comparable websites that used to compare insurance products, they started with term insurance because they're very easy to compare. You pay premium, you get a benefit, and hence it's because it is really simple and easy to compare, right? So if you could compare, let's say, two different pens, it's just like that in terms of comparison. Other insurance products wherein the benefits could be very different. One product could cover something else, other product would not have that benefit, and then it becomes very, very difficult to compare. And the last piece, of course, it gives a safety net. So term insurance, for that matter, becomes like a brake in a car, right? So if you have a brake in a car, you don't go slower, you actually can go faster because you are sure that there's a brake in a car and it would work when the time comes. So it's really that safety net that all of us should have. So moving on to the next slide. Who should buy term insurance? Now we know what term insurance is. We also know why it's a good idea to buy term insurance. The question that you need to answer now is who should buy insurance? So essentially, term insurance is for someone who is a breadwinner and he or she has dependents. If you have an outstanding loan like a home loan or a car loan, then it is a good idea to buy a term insurance. And if you want to provision for milestones like for kids' education or kids' marriage, and that's part of your financial planning, you want that to be taken care of with or without, regardless of whether you are around or not. And then term insurance becomes important. So that the first three reasons of buying term insurance are from a protection perspective. Buying a cover so that your family is taken care of for the rest of their lifestyle, and the goals are achieved. The fourth reason, which is legacy, leaving legacy, is essentially for those who think that it's a good idea to buy term insurance and use that as a way to pass on wealth. So buying a cover maybe in 40s or 50s, a high cover which essentially is good enough for their family to take care of themselves, uh, when the death happens at a much later stage, right? So this is generally a cover till 80, 85. uh, given a, given the given the age limit that we have, given essentially the longevity that we have, 80, 85 becomes more like a term, more like a whole life cover for most of us. So now let's also talk about who doesn't need a term insurance. So if you do not have any dependents or do not have any liabilities, you obviously do not need term insurance, because nobody is financially impacted in case you are not around. The second is, if you already have enough assets so that your family is taken care of without the income that you would have generated, then again, term insurance is not important. And let's say if you have achieved financial independence, then term insurance again becomes irrelevant. But having said that, I think it's important to highlight that a scenario wherein someone is 25, has no student loan, no home loan, no car loan, parents are not dependent, and the person is still not married, right? So theoretically, the person doesn't need term insurance. But again, it might just be a good idea to consider buying it, because when you get in early, you lock in premiums which are very, very cost effective, and you ensure that you are covered even if there is a health condition or medical condition that happens in later years, right? So those who are in early 20s, technically in most cases they do not need term insurance because they don't have liabilities or they do not have dependents, but it might just be a good idea to consider in buying one. Moving on to the next one. So how much coverage does one need, right? So you need, and we'll spend some time here. Most people think of it from an eligibility perspective, which is how most insurers, and that's where the rule of thumbs comes in handy, right? So typically the way people think about it is, okay, 10 times the annual income or 20 times the annual income is what I should end up buying. And I think it's far more a nuanced calculation than using a rule of thumb for something which is very, very important for your life and your family members. So the 10 times annual income or 20 times annual income is really the eligibility, right? It's really the upper limit of your sum assured, because insurance companies are really trying to see here is that what does your value look like in terms of money if you would have earned for next 20, 30 years, right? Which is, in very simple calculations, is 20 times your annual income. But that's really the upper limit. What you need could be very different, and it requires some more thought. Here we'll go through a very simple example which will give you some idea of how it should be looked at, but again the calculations could be a lot more nuanced. The first thing that one needs to consider here is the future expenses the family would have for rest of their lifetimes. So that becomes one important part. The second is the outstanding liabilities that you might have, which is basically loans, home loan, car loans, or student loans that you might have. And the third is one-off expenses that you would have planned for, which could be, let's say, ensuring that savings for basically your kids' education, kids' marriage. Those are one or two financial goals that you want to be taken care of, regardless of the fact you are around or not, right? So if you think of these three as an important pillar of arriving at what your sum assured is, then essentially uh, all one needs to do is take care of, project all future expenses and discount it to current time, because these expenses would happen at a future time, but death could happen at any point in time. Add outstanding liabilities to it because they are anyway in current value terms. And then also one-off expenses at a later stage, also needs to be discounted in current times, because if you put in some money now, eventually it will grow at a certain rate and you'll get there. And if there are any assets that could be used, that needs to be deducted. So essentially, going back to our example of who doesn't need term insurance, where assets are big enough to take care of all these heads, then you don't need term insurance. In a simple math calculation, this becomes a negative value, right? So uh, let's now understand this, or cement this with an example, right? Think of someone who earns about uh, 20 lakhs a year, is age 35, has a fixed deposit of 5 lakhs, wishes to retire at 60, has financial milestone of kids' education, uh, has a spouse, two dependent kids, and spouse is of age 32. For this person, let's together try and calculate what should be the sum assured for him, right? There are some more details that you would need to do the calculation, but let's do it together. We'll move on to the next slide, wherein there are some more details that you would need, the numbers that you would need for calculation. And let's do it together. I'll take a pause for a minute or so, and hopefully some of you, and those who are able to find out the cover, please do mention in the comment section. So for this calculation, we need to know the living expenses, which is, in this case, is 6 lakhs per year. Let's make it simplified, saying that, okay, the expenses, of course, would increase using inflation, because of inflation, but there's also interest rate that would offset. So we're saying, okay, 6 lakhs remains flat. There's outstanding home loan, outstanding car loan, which adds up to 50 plus 555. And there's also you want one-off expenses to be covered, which is financial goals. That's about 100 lakhs. And then you have a financial asset of 5 lakhs, which could offset a part of your cover. We'll take a pause for a minute, which should be enough for you to calculate term insurance, size of term insurance in this example. Do post your answers in the comment. So we'll see whether people have replied their answers on comment. But for a benefit of everyone, the answer is 2.5 crores. Essentially, it's 150 lakhs plus 55 lakhs plus 100 lakhs minus 5 lakhs, which essentially adds up to 2.5 crores. I hope some of you would have got it right, and we'll check later at towards the end of this presentation or masterclass. So we've answered what is term insurance, who needs it, who doesn't need it, why it's a good idea to buy it. We also understood now what should be the size of the cover, right? And at this point in time, it becomes important to understand what are the factors that one should consider while buying term insurance. As Indians, I think premium or price becomes an important part for any of our decisions. So it's important to have that as a consideration, but buying cheapest term insurance may not always be a good idea, and hence other factors become important. To give you an indication of what drives premium, it's really age, it's gender, it's smoker status, and some insurance companies also use city as a parameter to come up with your premium rates. The second thing, in terms of thinking about what you should consider, is basically the product, the appropriate size of the cover. Appropriate size is what we discussed a couple of minutes ago. The duration, right? So the duration typically should be the time you need cover, which either could be time till you are earning, or the time till you become financially independent, which is generally uncertain. So most people end up buying cover for the time they intend to work. So for example, if you're 35 and you intend to work till 60, the duration of cover generally becomes 25. And then what riders? It's important to also look at riders, think of them as an add-ons on top of base cover. And we'll talk about them in greater detail at a later point in time. And the third important factor becomes insurer, which essentially is a proxy of what is the chances of your claim getting settled, right? Because that's really one thing that we are looking at. That if I pay premium, if I declare everything declare everything correctly, I should get claim if the time comes, right? So when you're looking at insurer, what we're essentially trying to see, what are the chances of my claims getting processed? And that's where brand, claim settlement ratio, the solvency ratio, claim settlement process becomes an important parameter. So moving on to the next one, we briefly mentioned riders in our previous slide. Now let's dive deeper into it. Think of riders as maybe toppings on your pizza, or yeah, that's I think a better way of thinking it. And most term insurances, a product would have 4 or 5 types of riders. One of them is critical illness, so it would take care of you in case one is diagnosed with a critical illness. The second is accidental death, which in generally means in case the death happens because of accident, you get twice the cover. The third is accidental disability cover, which means that yes, you are alive, but because of an accident, now you're disabled and you can't work, right? So it's a good idea to have disability cover in general. And the other two are waiver of premium type benefit cover. So if you get diagnosed with a critical illness, chances are that your income would reduce, and chances are that you may not be able to pay premiums, and hence it's a good idea to get your premiums at least waived off, and reduce one burden that you might have when the income is reduced. Same goes for waiver of premium for disability income, a disability rider, which means that in case of a disability, your all the future premiums are waived off. Now we have a flavor for all these riders. Let's dive a bit deeper and see whether it's a good idea. What are the pros and cons of buying it a rider or buying them as a standalone product? So critical illness, some of you would know, while it is also sold as a rider, there are also standalone critical illness products offered by health insurance or general insurance companies. So the interesting thing about riders when they come along with term insurance is that there are some fundamental limitations. The fundamental limitations are that sum assured of rider can't be more than the base sum insured. So, for example, if the base cover is of 1 crore for term insurance, and if you need CI cover of 2 crores, you just can't buy it because there is a rule stopping you from doing it. The second fundamental restriction is the premium for rider can't be more than the premium for the base sum assured. So, which essentially means that if a rider is more risky, chances are that your cover for that rider would be a lot lesser. So these are the fundamental restrictions when you go for buying riders like CI cover or disability cover, and then some riders may or may not be as comprehensive as a standalone covers offered by general insurance or health insurance companies could be. They could, and then the definitions could just be could be restrictive in case of riders. So this essentially takes care of critical illness cover and the disability rider. Now let's also talk about the accidental death rider. In my case, in my thought, it serves very little purpose, because ultimately, if your base cover is good enough to take care of your insurance needs, it doesn't really matter what is the cause of death, right? And there's no reason why getting double the cover is a good idea. There could be some edge cases, very extreme cases, wherein this could come in handy. So if you think of an example wherein someone is unable to get the right term insurance and is exposed to kind of job where accidents are a lot more likely than others, and only if the person dies due to accident, he gets double the benefit, and in that scenario the financial needs are met, right? Then buying an accidental death rider makes a lot more sense. Otherwise, getting double the benefit just because the source of death was something else, was this accident, doesn't make a lot of sense in my head. The remaining two riders are very, very critical, which is waiver of premium for critical illness in case of critical illness and waiver of premium for disability. These are very important because in case of events like critical illness or disability, you already are suffering from dealing with many challenges, and one of them is lesser income or loss of income. And paying premium on top of that becomes an added pressure. But not paying premium would mean that your cover would also, the base term insurance cover would also be gone, right? So in that sense, it's a good idea to have the last two riders, that is waiver of premium for critical illness and waiver of premium for disability. Uh, so now we have covered the things which are more important, and some most part of it was known to most people. Now let's get into what is things which are a lot more nuanced and lesser known. One of them is material disclosure, which essentially is saying that everything which is important for an insurer to make a decision whether they should offer you a cover, and if they offer you a cover, they cover on a standard rates or a higher rate, becomes a material disclosure. An example of it could be a medical condition. An example of it could also be that you already have a cover from another insurer. It becomes important because insurers want to know that you're covered just enough to take care of your financial needs and you're not profiting from death or term insurance for that matter. The free look period essentially is an option to, let's say, cancel the subscription. So let's say if you subscribe for Netflix for a year, you cancel in the first month, you're charged only for, let's say, first 15 days that you're used. In case of free look withdrawal period, which is generally 15 days, you pretty much get your entire money back with some deductions around admin costs, right? So if you bought a policy, entered into a contract, you still have 15 days to not continue it for rest of the time. And term insurance, interestingly, is a worldwide cover, which essentially means that if you buy from an Indian insurer and the death happens in any part of the globe, the claim would still be honored. The fourth is death payout options. So in the most classic form of term insurance, the death benefit is a lump sum amount. So 1 crore, 2 crore, 3 crore, whatever that amount is generally paid in lump sum to the family members. But there are also now options wherein you could say, okay, 50% of it is a lump sum, but rest 50% is spread over, let's say, next 10, 15 years. The rationale behind is that the family may or may not be savvy enough to invest or basically they would not know what to do with, let's say, 3 crores that suddenly came into their bank account, right? And it could also mean that some of them can get some of that amount can get exhausted very, very quickly. So in those scenarios, it's a good idea to consider maybe a spread out payout spread over 10 years, wherein the family gets a regular stream of income for next 10 years. The thought there, or the consideration there, is if the family is savvy enough to take care of the money, then it's probably a good idea to take the lump sum. And why keep it with someone else, right? So that's a thought. That's a consideration that one should have. The fifth one is Married Women's Protection Act, which essentially means that, and it's an option that you get only at the time of buying the term insurance. You don't get that option at a later stage, right? And this essentially means that, let's say if you bought term insurance and you also had outstanding loans, but if you bought a policy under this act, the entire sum assured goes to your family members, and your creditors can't come back asking for portion of their outstanding loans. So it protects your family from a part of your sum assured going to settle outstanding loans. The next one is premium frequency. So premium frequencies are typically monthly, quarterly, half yearly, or yearly. And the reason of having different premium frequency is that sometimes annual premium could become a very large amount when compared to an income, and it could impact cash flows. So people might want to spread it out, let's say monthly, quarterly, or half yearly. The the consideration there is that if you go for monthly premium option, if you miss out one or two premiums by mistake, your policy then gets lapsed and you lose cover for the rest of your lifetime. Uh, but in an annual premium, you the window is slightly longer. You have a, I think, window of 45 days wherein you can go back, pay your premium, and the policy gets reinstated. The next one is premium payment options. And in here, you have an option to pay regular premium, which essentially means that if you have a cover of 30 years, your premium would also continue for 30 years. The second option is limited pay options, limited pay premium, wherein, let's say, if your cover is for 30 years, you pay premium for only for 5 years. And the third is single premium option, which essentially is if you have a cover for 30 years, you pay the entire premium in one go. From a perspective of managing cash flows, regular premium becomes a good idea. Limited premium is an interesting feature for those who have a very short career span. So maybe think of, let's say, actors or sports men, right? Or sportswomen, for example. So they have a career window of only, let's say, 5, 10, 15 years. So they would want to pay all the premiums during that period while they're still earning. And hence, limited pay premium option becomes an interesting feature for them. A single premium, likewise, someone who has money lying in, doesn't know what to do, could just pay out premium and be rest assured for the rest of the lifetime. The last bit here is uh, ensuring that your nominees are identified, uh, the proportion that would be used to distribute your sum assured or the benefit is also identified in your policy document. Because ultimately, you're doing all this exercise of identifying the right cover, the right product, and eventually buying it is to ensure that your family members are taken care of, right? So nomination then becomes an important part of the entire exercise, wherein you're essentially saying how the money would be distributed in case of an unfortunate event. Uh, Moving on to now the next slide. Uh, while what we discussed right now is something which has been there for a while, good 10, 15, 20 years, uh, like any other field, there are innovations in term insurance as well, and we'll talk about two of them. One is fairly recent, and it's called zero cost term insurance plan. Uh, everyone understands that there are no free lunches, right? So what is the catch here? Uh, but before that, let's understand how it works. So essentially, the offering here is you pay premium, and the day you think that you don't need term insurance, let's say 5 years or 10 years down the line, you get all your premiums back. Which essentially means that your surrender value for your there is a surrender value for your term insurance, which is same as the premium that you have paid. If you do a comparison, you would realize that the premiums that you pay here is higher than the premium that you would have paid without the zero cost benefit, or without a benefit wherein you have an option to get back your premium. So the way I see it, it's essentially a product which is more like a veg sandwich. So eating veg is important part of a healthy lifestyle. But if you don't want to eat, if the only way you're gonna eat vegetables is by eating veg sandwich, then go ahead, do it. So the extra bread that you eat is not something which is required. It's also the extra premium that you pay. It's probably also the slightly unhealthy part of the product, but it at least ensures that you're covered, right? You at least end up buying term insurance and your family is covered. So people who find it very difficult to digest the fact that I paid premium, but what if I survive, right? I won't get anything back, and hence don't end up buying term insurance. I think something like this works for them. The second set of audience for whom this could work is who are not sure of the, let's say, duration of the cover, right? So you don't know whether you need it for 5 years, 10 years, 30 years, and you don't want to commit. But an option like this makes it easier for you to get out of the contract because you know that you would get your premiums back. And if you're nearing retirement, or nearing financial independence, you know that you would not need cover in next 5, 10 years, but you just not very sure, right? But you're very, very close to it. You could consider buying this product and get out when you don't need it. The second set of innovation that has happened is, which is I think is an important one, is a term insurance for diabetic patients. And if you could go on to the next slide. So earlier in the discussion, we mentioned that insurance companies are keen on covering them who are a good risk, people who are healthy, who are less likely to die during the policy contract, uh, and offer a premium rate which is very, very competitive. But now, given India happens to be the global capital of diabetes, there is a sizable chunk of people who have diabetes and largely go remain uninsured because they were not covered in the regular plan. So now some insurers have come up with a term insurance which is only focused for people who are diabetic, and of course, there's conditions that HbA1c should be less than 8. It should be type 2 diabetes, but the good part is that they at least can get covered. They end up paying slightly higher premium, but everything else remains just the same. You pay higher premium. You need to be you have a HbA1c level at below 8, and it should be a type 2 diabetes, and you get covered. There's also no limit on sum insured. Of course, there's an underwriting that insurance companies would do to understand the risk that they're taking on. Moving on to the next one. So we've covered quite a few things. There are few small little things that it might be a good idea to cover. The first one is very important. That is filling your proposal form. So we tend to outsource the most important part of this entire buying journey. That is asking someone else to fill the proposal form, when the kind of details that is required may or may not be known to the person. The details could be your smoking habits, your drinking habits, your medical conditions, the other insurance cover, especially the term insurance covers that you have bought from other insurance player. These are very important details, and the person filling it may or may not know it, right? And which could mean that it could be seen as a false representation of your financial and medical condition, which could mean that your cover might just get denied in case of an unfortunate event. So it's a good idea to spend that 35 minutes, fill that proposal form so that you have the peace of mind for which you are buying the term insurance product. It's a good idea to also look into the claims settlement process of some of the insurers, because ultimately, in case of death, the family is already in distress, and you would want them to at least save with some of the troubles that get added because of getting the sum insured, getting the benefit back, right? So it's a good idea to buy a product from an insurance company where the claim settlement process is quite smooth. Nominees we have discussed. Disclosing current policies is something we have discussed. And if you, the fifth part, which is what I did for when I first bought term insurance policy, which I had designed, by the way, I told my insurer, which was also my employer, that I wish to indulge in adventure sports, and if a death happens during while I'm doing an adventure sport, I would want to get covered for, right? So it's a good idea to declare it if you wish to indulge in adventure sports, so that even in those scenarios you are covered. And of course, the last part is also we discussed, that is buying policies under Marriage Women's Protection Act. Moving on to the next one, which is really the last part of this masterclass. So what happens after you've bought the policies, right? There's not much to do. Pay premium, and especially if you have if you have taken the monthly premium option, it's a good idea to have an auto debit, right? An auto debit, not with a credit card, but with a bank account, because credit cards generally have a validity limit, 5, 6, 7 years. And you may not realize the credit card expired, and then your standing instructions started failing, and then the policy got lapsed. So it's a good idea to do a standing instruction with a bank account that you're going to have for very long period, like 20 to 30 years, right? So that's one thing that one needs to do. The second, it's a good idea to also review the size of cover one needs. And a good example of this is when you are in early 20s, you might need a higher cover at a later stage of your life, but your eligibility criteria doesn't let you buy it. So, for example, if someone is 25 and maybe earns 10 lakhs a year, the maximum cover that insurance company would offer has a limit, right? It's 10 times annual income or 20 times annual income. So let's say it is 2 crore. But by the time you are, let's say, 35, you realize that the expenses of your family, not just you, but your wife, your spouses, is so high that 2 crore becomes a very small, it looks like very small, right? So you might want to increase the cover. So you would only increase the cover only if you know that now your requirement is much higher than what you already had. Some term insurance policies do have an option to increase cover at life stages. That is when you buy home, get married. But those are also capped at twice the base sum assured. And in some cases, your requirement could be more than twice the base sum assured. So continue paying premium and then also review the size of cover that you need at regular intervals. And in case of unfortunate event of claim, I think there's not the process is simple, at least on paper. Is reach out to insurer, mention them the situation, submit all the documents that they ask for, be truthful, just so that your claims is not rejected on the grounds of fraud. And uh, from my experience, as long as the proposal form was filled by an individual and the truth was stated in the proposal form, uh, the claims do get paid in nearly every scenario, right? I haven't seen anyone who had a genuine reasons of claim, a genuine claims, and the claim was denied. So ensure that you fill your proposal form yourself and also state all the required facts. Uh, it could mean that you end up paying higher premium, but that would ensure that your claims are at least taken care of. So this is pretty much all we had today. Happy to answer any questions that you might have.
Thank you so much, Sumit sir. It was absolutely insightful. The session was. There were a lot of questions that I myself got
Sure.
some answers to. Thank you so much. So let's take some questions. We are live right now on LinkedIn, Instagram, and YouTube. So we have received some questions. All right. So first, let's take a question. Okay, there's Mrs. Naina ji who's asking, what is the approach for a housewife when it comes to taking term insurance?
Yeah. So I think this is interesting. So going back to our original slide where we talked about who needs term insurance, right? And we talked about three things: someone who earns income, has dependents, or has outstanding liabilities. Because insurance companies would want to cover people who, if there is a financial loss in case of an event, right? In case of housewives, it becomes very difficult to justify the financial loss. But then there's an interesting thought. So I was talking to someone, and I think it's in worth thought for insurance companies to consider. Is this guy said, okay, I need term insurance for me, let's say 5 crores, and I want the exact same cover for my wife as well, who doesn't work. And his rationale was, if I die, yes, the cover goes to my wife, and my kids are taken care of, and wife is taken care of. But if my wife dies before me, then I would want to go back to home, spend time with my kids, so that they are unimpacted, right? So I would need that money, and hence I would want my wife to be covered. The reason why housewives are not covered is basically there's a concept of financial underwriting, which means that if there is no reason, is basically what insurance company is trying to understand is, if there's no reason for is the person to get insured, why would you insure it for a higher amount? Because that really means that there's a risk lying in there, right? You would want to profit from death of someone who is not insurable. But then it's equally important to realize that laws of the land still hold, right? One would not uh, make profit from a death of someone else by actively indulging in it. So it's something that I think it's worth considering, and a thought for insurance companies maybe.
Okay, that was your answer, Mrs. Nainaji. Okay, we have Rajneesh Roy, sir. He's asking, what do you do when your habits or health condition changes during the tenure of the term policy?
So we're generally not required or obligated to inform insurance companies. Uh, uh, but yeah, it's for on one's own good, right? To continue to maintain a healthy lifestyle. But you're not obligated to inform insurance companies.
Okay. Ankit sir is asking what are the basic parameters before you buy the term insurance policy? We have covered during the PPT. Do you want to just name 5 of them or something around it?
Yeah. So I think as a buyer, you would want to think about premium, which is the price. You would want to think about uh, the size of the cover, which is important part of it, and you would also want to consider the claims part of it, which is essentially how smooth the claims process would be. Uh, it's not that one company would not pay claims if it is so every company is required to pay claims if it's a legitimate claim, right? So that would happen. It's more about the claims process, how smooth it is, how fast it is. But yeah, those are the three important considerations for a buyer.
Okay. What happens if I outlive the policy? So this question is from
Yeah.
Akash, and absolutely, like you don't have a maturity benefit here. So what
Yeah.
happens then?
Yeah, so you don't get anything, right? It's like asking, I locked my home when I stepped out. I came back, but nothing happened. So was the lock useless, right? Did the lock not serve its purpose? It did, right? It ensured that people did not come in. So term insurance essentially served the purpose of ensuring that if there was an event, you would have been taken care of. So yeah, you do not get anything. The short answer is you do not get anything. And for it's if it is something which is difficult to digest, I think Vet Send is for you. Buy zero cost term insurance plan.
All right.
But at least get yourself covered, right? Because that's the important part.
Sure. Okay. What happens if I miss paying a premium on time? I have missed one. I even crossed the grace period. What happens next now, and what should be my process now to take care of it? So, Mr. Prakhar Gupta sir is asking this question. Yes.
So it's a good idea to go back to insurer and understand what their policies are. But some insurers also have a reinstatement drive, right? Wherein they say, okay, we'll reach out to everyone whose policies was lapsed in last 2 years, and they'll pay the dues and they'll be taken care of, right? So reach out to your insurer and understand what policies they have. And let's say if there's no option to reinstate it or get your policy back revived, then just buy another.
Okay. We have Mr. Jagar Mehta, sir, is asking, is a simple traditional term plan better versus the return on premium term plan?
Yeah, so return of premium plan is a variation of zero cost term insurance plan. In return of premium plan, you essentially get your premium backs at the end of the term. In zero cost term insurance plan, you get your premium back anytime you decide to discontinue. So again, my answer is that if it's difficult for you to digest that, how do you not get your money back if you survive? Then buy ROP, a return of premium plans, but get yourself covered.
Okay. All right. Neha is asking that I have migrated, my country of residence has now changed. Will the policy still provide coverage to me?
It should, but again, it's a good idea to check with your insurer.
Okay. All right. Let's have one more question. Okay. So we have this question. Do term policies cover accidental deaths? This question is Mr. Uttamji. Yes.
Yeah, term insurance would cover every form of death as long as it's not suicide in the first year. After that, the suicide would also be covered. And in some cases, the drug abuse, the deaths because of drug abuse is also not covered, but it's covered in all normal circumstances.
Okay. Let's take just this last question, sir. This question is from Mr. Ashish Thakur, sir. He's asking, can I expect my premium to change in the future or it remains the same in the entire tenure? I do have a term insurance plan with
So
me.
term insurance premiums, the way they are sold or designed in Indian context, they remain constant for the rest of your life.
Okay. All right. So we have some questions where we have been asked that which is the best term insurance for yourself. At One Finance, we prefer hyper personalized advisory only, so it will not be right for us to really answer this question. But Sumit sir, do you want to give a answer to this or give any heads up to our teams who is asking these questions? Yeah.
No, I think I would not want to address it
Absolutely.
largely because I think I'm not qualified to advise in that sense.
All right.
And this is not the platform because generic advice doesn't make sense.
Absolutely. Hyper personalized advice is very important. You should not take generic advice like this on any platform. Go ahead, go to your financial advisory firm, go and share your personal aspirations, needs, milestones that you may have to achieve over the time. And that's when a proper plan is made for you. And then obviously a term plan, which is a part of it, needs to be hyper personalized as well. So we have covered a lot of questions.
Yeah.
Thank you so much, Sumit, for coming
Thank you,
today
Sonam.
and sharing so much valuable insights with us and with our viewers. We every month come with a masterclass, a different topic that covers a lot of parts of your personal finances. Through this masterclass, we aim to empower you to take informed decisions. So keep joining us on a masterclass. We are going live on our website as well. So you can find all our masterclasses on one page now on the One Finance website. Do go and check out. And yes, absolutely. Thank you so much again, sir.
Thank you for having me here. And I hope it was a good use of everyone's time who joined in.
Absolutely. Thank you again and see you all again. Bye-bye.
Thank you.